Greetings traders and welcome back. Thank you for joining me for another In-Depth with Chris episode. In today's discussion, we will be covering stop loss orders versus stop limit orders. Both of these are tools that are used on a daily basis by traders everywhere to not only limit their losses, but to preserve their gains. As traders, we don't want to give our hard-earned profits away, and these tools can help us do just that. We can preserve those gains. And if you are one of my traders that's attempting the Gauntlet Mini to showcase your skills, you think you have what it takes, well, this is something that is a crucial must for you. But without further ado, let's get going. A wise man once said, "You've got to know when to hold 'em, know when to fold 'em, know when to walk away, know when to run." That wise man was Kenny Rogers. It had nothing to do with trading, but it is something that can absolutely be applied to today's discussion, and that is the stop loss and stop limit. Ways to preserve capital. There are two types of stop loss orders. We have the sell stop order, then we have the buy stop order. Now, these are basically just two sides of the same coin that allow us as traders to protect both long and short positions. And in many ways, using these takes the emotions out of trading when we need to get away from a position that may not be going in our favor. So removing the emotions, as most of us are well aware, can be very beneficial to us as traders. Unfortunately, a lot of times when things are providing a negative emotional response to us as traders, it influences our decision-making process, usually in a negative manner. So with these orders, the sell stop order and the buy stop order, it's quite simple. When the trade or the contract price hits a certain level, boom, our trade is executed, no second thoughts, no backtracking, it is just simply done and closed. Here we have a 6-month graph of the E-mini NASDAQ 100 to help us visualize the idea of a sell stop now. So with a sell stop, what is the concept here? Well, fear and greed, it dominates the investment markets of all types. It often clouds the judgment of investors that are striving to lock in that last dollar of profit. These emotions can also prick the ego of traders who are going against the market and unwilling to accept that they may have gotten it wrong. A sell stop order is a strategy that is relatively very basic. If the contract falls below a particular level, then this will trigger at a sale or at the prevailing market price. There can be a major downside, however. In a fast-moving market, the actual execution price could be very different to the sell-stop limit level. It is probably easier to show an example of this, which is why we went ahead and threw this graph on screen. In recent times, we have seen an extremely volatile NQ phase, which has prompted a lot of activity being enticed to trade it, because volatility does in fact provide opportunity. As you look around this chart, you can see that there has been a number of short to medium term trading opportunities, technically in both direction. If we put aside the gearing impact of futures contracts and look at the index movements in isolation, there have been numerous opportunities to use sell stop orders to protect potential or hypothetical profits. This 6-month graph highlights an uptrend from the 18th of December, which was around 85.80, to a peak on the 19th of February around 97.18, which equates to somewhere around an 1100 plus point move. Continuous adjustment of a stop loss limit may have well seen a sell stop order prematurely activated towards the end of January, when there was a short-term dip that was from 92.16 to 89.52, but even that would still have crystallized an impressive profit. Those with a long-term outlook may have been more cautious with their stop loss limits, retaining their position until the peak of the 19th of February up at the 97.18. The market began to turn on the 20th of February, and in a worst-case scenario, a sale would probably have been activated on the 21st to the 24th of February. This would have allowed the investor to realize a very healthy profit, before an even greater collapse. So whether maintaining a tight or wider stop-loss limit, investors using this approach would have realized large profits and avoided the worst of the 2,700-point fall to the 20th of March. On the opposite side of the coin, as we can see here, the collapse of the NQ between the 10th and 11th of June, which was a fall from above 10,000 to around 9,600, would likely have wiped out much of the short-term gains, turning the position into a loss from the previous uptrend. Unfortunately, due to the speed of the market collapse, a sell-stop order may have seen futures contracts sold at a huge discount to the previous evening's close and the prevailing stop-loss limit itself. Sell-stop orders work best in less volatile markets, but we normally wouldn't expect a 500-point fall on an index during a 24-hour period, so it should be clarified that this is an extreme example. But in many ways, this highlights a potential downside for stop-loss orders. Using our previous graph, we can now understand what a buy stop order would look like. And as we look around, we would see numerous opportunities here on the NQ where we could have shorted the market. On the 19th of February, the market peaked at just over 9,700, then began a downtrend, which would bottom out somewhere around 7,000 on the 20th of March. Imagine if you had taken a short position at the very peak. How would this have panned out? Well, in all likelihood, the serious volatility in the following days would have probably triggered a stop-loss limit of even the most adventurous short traders. However, even a buy stop order triggered on the 27th of February, the first market bounce would have still benefited from nearly a 1,300-point fall in the index. Those who maintained a position when the market bottomed out just below 7,000 on the 20th of March would have seen their stop-loss limits triggered fairly quickly when the market bounced. The beauty of using a buy-stop order to protect a short position is perfectly reflected in the fact that the index hit a new all-time high at just under 11,000 on the 10th of June 2020. This no-nonsense approach to using buy-stop orders takes away the decision-making process when these triggers are breached. Keeping the graph theme alive, we can see some of the differences highlighted between both the sell-stop orders as well as the buy-stop orders. And the first is if we compare the target price of each of these orders. With the sell-stop order, it is going to be below the current price. So target price for the sell-stop order is below the current price, whereas with the buy-stop order, it's going to be above the current price. Once again, these are just opposite sides of the coin. As far as the transaction goes, the sell-stop order is going to be representative of a sale. And as far as the buy-stop order goes, it is going to be representative of a purchase situation. The upside to the sell-stop order is going to be that it protects a long position. The buy-stop order is going to protect the short position. The downside means it is going to be guaranteed to trade, but no guarantee on price. So that means we are guaranteed to trade, but we don't have a guarantee on exactly which price will be filled with our sell-stop order. And then the buy-stop order is going to be exactly the same in this concept. It is guaranteed to trade, but there is no guarantee on the price. Some traders may see the stop loss and stop limit orders as being one and the same, but the truth is there are some subtle but very important differences. With a stop loss order, when the contract price hits that level, a trade is triggered and executed at the prevailing market price. A stop limit order is a two-stage affair, with the initial price activating a stop limit order and a second minimum price limit allowing traders a degree of control over the transaction price. So this ensures that in fast-moving markets or sharp movements in contract prices on the open, investors are not committed to a sale at any given price. So this is something that can be very important when we imagine the previous examples where we're talking about high degrees of volatility when the market is making sudden and sharp moves. That is a situation in which a stop limit order would be more suited to me personally, as well as more suited to most traders out there. We don't want to just say, oh, well, if the market spikes, then we're going to just go at the gapped price and unfortunately get a terrible price. Instead, we want to give ourselves a limit of the minimum price that we're willing to accept. Which brings us to the age-old question, which one should you use? Well, there is no one-size-fits-all here, which is why it's important to understand how each of them work. That way you can understand the scenarios in which case one may be better suited for you. And the easiest way to do this is by analyzing how they impact different styles of traders. So we'll look at short-term traders and we'll look at long-term investors. Short-term traders, which is where most of us fall under, including myself, we have one thing in common. We tend to cut our losses fairly quickly and we like to run our winners. We like to focus on relatively volatile contracts. Sell stop orders tend to be the preferred strategy in this situation, and pricing can be relatively tight. This will see losing trades jettisoned fairly quickly to focus on those moving in the right direction. Short-term traders like myself tend to have little interest in medium-term contract recoveries. Therefore, even a quick-fire sale below our initial stop-loss limit would not be the end of the world. Now, long-term investors. By their very nature, long-term investors and traders take a more long-term approach to their investments and as a consequence are perhaps more suited to the stop limit order strategy. They will often have a target index level in their mind, and assuming the fundamentals don't change, they may be happy to wait for that level. That is not to say they won't continuously reassess the prospects for their investments, but they are less susceptible to short-term, often volatile price movements. They do tend to trade on the philosophy that fair value will often prevail in the end. The advantages from each of these order types can be summed up into four essential statements. We have the fact that stop limit orders offer a degree of protection from extreme price volatility, and that is absolutely an advantage in certain market conditions. Then another advantage is that stop loss orders can limit further downside, especially in a fast-moving market. Then we have that relatively low stop loss order prices can protect against short-term volatility. And finally, stop limit orders allow investors to reconsider their position if the limit price was missed. The potential drawbacks would be that stop limit orders guarantee a minimum price but no certainty of executing a trade. The stop loss orders guarantee a trade but no certainty of price itself. And then we have that stop loss orders are final and definite. There's no room for emotive decision-making process. Now, once again, these are potential drawbacks, meaning they're not definitively a drawback. It is all how you look at it. Now for everyone's favorite part, the frequently asked questions, just to make sure you remember what we talked about. Question number one is going to be, when looking to buy or sell contracts, is there any scope in using both the stop loss and the stop limit strategies? The short answer here is yes. Let's assume we have a stop limit order which kicks in when whatever index we're looking at falls to 9,900 with a minimum limit of 9,800. An additional stop loss order at 9,500 would act as further insurance in the event that the futures contract price moved too quickly to complete our order at the minimum price of 9,800. That should make sense. We use it as a backup plan for the backup plan. Number two is going to be, what is better, stop limit order or stop loss order? Now, we did essentially cover this. The stop limit orders and the stop loss orders both have their own pros and cons, and ultimately it will depend on the individual trader. And there's no harm in using both of them like we discussed. It is something along the line of stop loss orders do generally seem more appealing to short-term traders, whereas stop limit orders seem more appealing to the longer-term traders. Number three is, are there any shortfalls relating to stop limit and stop loss orders? Well, both strategies do have the ability to be impacted by volatile short-term movements in contract prices. That is essentially the shortfall to both of them. But once again, the idea here is if you are unsure or want to be extra safe, remember to use backup to your backup. To sum it all up, both stop loss and stop limit orders are incredibly useful tools to employ as a trader. Neither one of them really has any notable serious downsides, aside from the simple fact that in extremely volatile conditions, they may not trigger. But other than that, it's hard for them to compound a loss. By the very nature, their job is to simply stop a loss before it gets too aggressive. If you're not using a stop loss, well, I am slightly concerned for your trading health. But until next time, guys, thank you for joining me. As always, please click the like and subscribe button down below for me. It does help me out and I appreciate it. Thank you very much, everybody. Good luck on your Gauntlet Mini, and I will see you soon.